Okay, this is Chapter 1, Part 2, and we'll get to work with some numbers here. The first thing we'll do is prepare a budget, and then we need to talk about some of the behavioral implications, actually, of measuring people. Okay, it makes an impact. So, Objective 7, what we'll do is prepare a budget and analyze a performance report of the lawn care company. And this is I did this at work for years, and it's fun, but you need to understand the business too, okay? It isn't just an accounting job. You're really more part of a management team. So you want to evaluate the inputs to consider when you're establishing a budget. Okay, what information do you need? Process it and prepare the budget. And then the outputs would be graphs, performance reports, in order to make decisions and take corrective action. Okay, so we may not think about these jobs being categorized this way, but this is exactly correct, okay? It's really an input, process, output job. So, we're going to, what's the difference here? Oh, that's the objective. So we're going to gather the information, then we'll use a spreadsheet here to process the data, to create a budget, to estimate revenue, costs, and expected profits, and then a sensitivity analysis to and change certain assumptions we made to see how these changes might affect income. For example, in a grass cutting company, what would happen if the price of gas went up? Okay, what would that impact be? The output will present information in a manner that's concise, clear, and relevant. All right, so management can use it and understand it. I mean, if it doesn't serve their purposes, then it's just a complete waste of time. So here's the annual budget for the lawn care company, and we've got 15 customers. They charge $30 per cut. The gas cost is $2 a gallon. Maintenance cost per customer per month is $1, and salary expenses per month are $500 per month. $500. Salary expense per month. Okay. All right. So I don't know how many hours they're putting into this, but okay. 500. Okay, there are different assumptions here. So the revenue, we've got $30 per cut times 52 weeks. That's $23,000 in revenue. And then the salaries expense, I hope you can see this. I'm going to make this bigger. Salary expense is $500 a month times 12 months, so just $6,000. Payroll taxes then are $1,200. Gas is the number of customers times $2 per gallon times 52 weeks, so $2,080. See, these expenses are adding up. Depreciation is $2,400. It's a non-cash item, but it's still an expense every year. Travel is $2 per gallon times 2 gallons a week times the number of customers for 52 weeks. So travel is $4,160. So it's probably a big truck with a trailer in that too. Repairs and maintenance, including supplies, is $240. And other office expenses, this is probably just a flat number. It's about, taxes, insurance, licenses, about $4,600 a year. So that would give us net income of $10,520. Okay? So here is the forecast of our expenses. This is what it looks like. And, the visual is good. Travel is a significant hunk here. And then we've got other office expenses. That's $4,600. We definitely don't want this number to go up. Okay, we want to really manage it and make sure it stays down. Salaries are $6,000. Of course, we're only making $30,000. We've only got 15 customers, so I guess it's a reasonable number. And there's payroll taxes and then gas. So make this a little bit smaller here. So we're going to analyze and plan. The managers examine the managerial information to better understand their operations and see how they can improve it. And what we can track is revenue and costs, and then how much money we're making, profitability. So this is the report, the performance report. So we came up with a budget. Here's our annual budget. We've proposed net income of $4,340. Okay, our revenues are lower than what we expected. Before we had $30,000 up, but this was $30,000. But who knows? Maybe we lost a couple customers. But we've got revenues, salary expense, payroll expenses, etc. Our actual, here you can see our revenues were a little bit lower than expected. The salary and payroll taxes were right on. Gas was a little bit lower. No change in depreciation. Travel was higher. Repairs and maintenance were higher. Office expenses, we budgeted $4,600. They came in at $4,320, which is good. So we saved some money there. But overall, our expenses are down by $214, but revenue is down by $810. So the difference there is $596 negative. Okay, negative variance. So this would be your performance report. Okay, so we prepared a budget, and then that's the report. So the next piece here is to interpret the behavioral implications of management accounting using the IMA Statement of Ethical Process and Ethical Professional Practice. So we'll distinguish between efficiency and effectiveness, define occupational fraud, and look at the Institute's 4 standards of ethical professional practice: competence, confidentiality, integrity, and credibility. And these are tricky. You need to be able to look at different examples and tell which category this belongs in. So we'll practice this in class, but don't blow it off. Okay, you want to take a look at that. So where am I now? Okay. Yeah. So, and we've got an ethical obligation to produce reports that are as accurate and complete as possible, and to adhere to standard accounting practices. So when people read our work, they know they can depend on it, and they know what kind of basic assumptions you're using in it. It needs to be effectiveness, achieving goals in whatever manner is necessary, and efficient. That relates to the resources that we use in creating it. Okay, I mean, you could have the Accounting Full Employment Act where you've got 50,000 people doing everything all the time, but that would not be efficient. Okay, here's some unethical behaviors. Using a company car for personal use, cheating on a test. Don't ever do this. Okay, if you need a break for some personal reason or something comes up in your life, just talk to your professor about that, but geez, don't cheat. Because, I can still remember everybody who ever cheated on a test to me. I can still see them. Can you imagine? So it doesn't happen that often. I don't think. If it happens, don't let me know. No, I'm only kidding. Playing games during work hours, coming to work later, leaving early, calling in sick when you're not really sick, sloppy work, using employee discounts to buy merchandise for friends. Okay, this is all unethical. Embezzlement for sure. This is all corporate unethical behavior. Embezzlement, kickbacks, dumping chemicals, inflating budgets so actual costs are less than the budgeted costs, underreporting sales in one period and shifting it to another period so that you can get a bonus, submitting false or exaggerated invoices for reimbursement, altering contracts or bank statements, substituting inferior materials, all of those things. Okay. Now the Corporate Code of Ethical Conduct, per the IMA, they suggest that you use that members exhibit competence. So that means maintaining technical expertise in accounting, and you want to make sure that you hire someone with the skills that are needed for a particular job. Confidentiality, keeping company information confidential from outside parties. What else do we have here? Integrity, being honest and trustworthy at all times. And credibility, presenting information fairly, objectively, and without bias. Okay? So competence, confidentiality, because everything we do is confidential. When you've got a financial statement, that's really public information for a public company. Okay? But for inside information and for managerial accounting, it's all a secret. Okay, you keep it all close. Integrity, being honest and trustworthy and credible, that you present information fairly, objectively, and without bias. So members of the IMA need to behave ethically. A commitment to ethical professional practice includes is overarching principles that express our values and standards that guide member conduct. So the principles are honesty, fairness, objectivity, and responsibility. Okay? The standards are competence, confidentiality, integrity, and credibility, the 4 that we just looked at. So the principles are overarching principles. Okay, honest, that you're honest, fair, objective, and responsible. Now you need to know the difference between these two things, okay? Meanwhile, we've got standards in competence, confidentiality, integrity, and credibility. And this is more, you can take a look at this yourself, but these are more detail on each one of these things. For competence, maintain an appropriate level of professional leadership and expertise by enhancing knowledge and skills. Perform professional duties in accordance with law, regulations, and technical standards. Provide decision support information and recommendations that are accurate, clear, concise, and timely. Okay, so you need to do practice ones on this book, though, before you really see what the differences are. Confidentiality, I think, is easy to see. To keep information confidential, except when disclosure is authorized or legally required. Inform all relevant parties regarding appropriate use of confidential information. Monitor to ensure compliance. And then finally, refrain from using confidential information for unethical or illegal advantage. Now, let's look at this next one here, integrity. Believe it or not, I think integrity is the one that's hard to see. We all know what integrity is, but it's difficult to apply to these examples. So we're going to mitigate conflicts of interest, refrain from conduct that would prejudice or carry out duties ethically, abstain from engaging or supporting in any activity that might discredit the profession, and finally contribute to a positive ethical culture by placing integrity of the profession above any personal interest that you have. Okay, so what else do we have here? Here's more characteristics of credibility. That you fairly and objectively communicate information, provide all the relevant information that you would need to make a decision, report delays or deficiencies in information, communicate professional limitations or other constraints that someone might need to know. Okay? And when you, resolving ethical issues is always a problem. You know, people, like if you ask a student, you know, tell them what you found in an organization under a particular manager, what should you do? And many times student will say, call the police, you know. But you don't do that. You actually go to their boss first. Okay? You want to seek resolution, but and you can consider all the risks, but you go to the next person up in the command chain, in the chain of command. So, yeah, the resolution process should include a discussion with the member's immediate supervisor. If the supervisor looks like they're involved, take it up to the next level of management. But also what's nice is that the IMA has an anonymous helpline that you can call just in case you're in a situation you're not sure how to handle it. Okay, you can call them and get advice on it. And you should also consider consulting your own attorney to learn of any legal obligations, rights, or risks concerning the issue. So that sobers you up, doesn't it? Yeah, just with any luck, you won't have to face anything like that in your organization. So here's a recap of that input process, output process model. The output, this is information is communicated efficiently and effectively to management to analyze the company's results and aid in operational and strategic decisions. So we've got this budget. Okay, this was our budget, our basic budget. There's the dynamic budget. The dynamic budget adjusts for changes in volume. That's what that does. So our input, there's the basic plus the dynamic. So the input is the total. We expect to make 40,000. Here's our actual, and here are the variances here. Okay. These are variances that are mostly unfavorable compared to budget. The actual, the actual was higher. It's good for revenue, but not so good for expenses all the time. And, operating income was lower than what we expected. So the next thing we can do is come up with a nice chart that explains what these costs are. Okay, that maintenance maybe was higher than we expected. The website costs were high. Payroll doesn't seem to change. Content management was 15%. Multimedia capability. Okay, this is a good example. I don't know if this is the lawn company or not, but it's a nice piece of information for a manager. I mean, it's easy to take in and you see what's important right away. As is this. Here's another comparison of cost. This is budget versus the actual. So our budget is in blue and our actual is in red, and we can look at these bars and see right away that the website costs were more expensive than what we planned. Okay, we saved some money here on multimedia capability, and the rest of them are pretty close, you know. And here's another comparison of static versus the dynamic budget. These are the revenues. The revenues were much higher. Cost is a little bit higher. Okay, you'd expect it to be. And operating income was also higher. So that's a nice bar chart. Okay, it's a good expression. One more piece here. Oh no, we're not going to do it. These are the reviewing GAAP for financial statements. My gut is we are not going to need to do this. But if we have to do it, I'll come back to it in class. Okay.